Hey guys, hello everyone, welcome back to my channel. Let's talk about Infosys today. There's a lot of buzz in the market that the stock has already corrected by 30%, and since IT sector is the hot sector for Indian economy in the near future, does it make sense for us to go long on Infosys? And we'll be looking into that in terms of what are the appropriate buying levels for this stock and what kind of returns you will be making in next 5 years. Let's start with the facts first. Infosys is currently trading at around 1435 rupees, and if you look at the price action for this chart, we have seen a peak of around 1800 or 1900, close to about that, and from there the stock has corrected by around 25 to 30% to its currently traded price, and it is currently trading at 1435. Pre-COVID, the price was around 800 rupees, and from there it has increased by around 2.5 times. If you look at the PE ratio, the current PE ratio is somewhere near 24x. The peak PE ratio that we have seen for this stock was around 38 or 39. And if you look at the pre-COVID PE ratios, it used to be in the range of around 20, 21, and 2 years, 3 years before COVID, it was in the range of around 16 to 18. So that is the summary on the PE ratio. So what we see that the PE ratio actually skyrocketed from around 23, 25 to around 38, 37, and then it has come down to normalcy of around 25, which again is high in my opinion. I will explain the reasons around that. Now if you look at the growth rate for this stock, uh, the last 5 years growth rate is around 16% in terms of revenue. 10 years it has been 14%, 3 years 17%. But what about last 1 year? Let me show that to you. So these are the official numbers from Infosys. uh, if you look at the last year growth rate, it is 21%. But if you look at the quarter over quarter growth, from 36.5 crores, 36.5k crores, 38,000 crores, and from there we have seen a negative growth rate quarter over quarter, which was not there for a long time for Infosys. We've always seen the growth rate increasing from Infosys even quarter over quarter. Even if you look at Q1 24, it has not touched the highest that we have reached of around 38,318. And the reason is mainly because the slowdown that we are seeing across geographies. If you look at US, even the European market, most of the revenue that Infosys is booking, it's currently coming from these two major economies. And if these economies are not doing well, there's a lot of pressure for Infosys to get their revenues getting booked from the clients that they own. And for that reason, we have seen that the commentary that is coming from the officials themselves, that they won't be having a good amount of growth in the near future. And also, since the recession or the slowdown is going to stay for next 2 years or so, we see that the growth rate will not be significant in nature. We will not be seeing a growth rate of around 14% or so that the company has seen historically. That is one thing that is not going to come again. um, that's one. Now if you look at the margins, the margins have squeezed a bit. We have seen margin of around 21.5%, but it has come to around 20.8%. So the cost pressures will also come in as the revenue is not increasing, so that will start squeezing and that will affect your bottom line. Now let's look at some of the assumption in terms of how is that we base our assumption in terms of valuing the stock for next 5 years. Currently, the net margin is in the range of around 16% if you look at trailing 12 months of revenue and earnings. The current PE ratio is 24, and the earning per share that we have is around 59 rupees. Now, we have created two views over here. One is on the conservative side, the other one is on the realistic side. On conservative, what I'm assuming in the next 5 years, I'm assuming the growth rate for the company to be around 12% annually. And the reason is very simple. Since the slowdown has come, since the US is slowing, uh, if you look at the growth rate, it may not be, it will be barely touching 10%. and I have taken an average of around 12% for the next 5 years, right? Realistic assumption, uh, we have bumped up the growth rate by 3% to around 15%. Again, on net income margin, if you look at the current net income margin, it will be coming down to around 10%. For realistic case, we have kept it as 13%. With that, what we are seeing is that the earning per share for FY28, it will be coming at 65 rupees and 96 rupees in realistic case. One more assumption that we have taken, which is a minor assumption in nature, is about the buyback that will be happening for the share outstanding. That will decrease the overall share count from 4 billion to around 4.1 billion to around 4.07 billion. That will affect the earning per share. Now, moving on to the PE multiple. PE multiple, as I discussed earlier, historically pre-COVID, it has been in the range of around 20 to 22 or 16, 17, 18, in that range. It's the industry-wide phenomena that we will be seeing in the near future. If you look at how things will be turning out, IT sector has always enjoyed in the last few years uh, being the best performing sector, but things might be changing going forward, mainly because as I see that the revenue pressure will be kicking in from now on. And if you look at how Nasdaq has performed, the Nasdaq has actually rallied by around 27% year to date, but we have not seen Infosys being rallied in that fashion, even though the companies are doing better off in US, but INFY is not showing signs of recovery. Now again, coming back over here, so what I'm trying to say is that the PE multiple of 23 is actually a high multiple according to me, what I would say, mainly because IT sector will not continue to command a scarcity premium or being the leading industry premium, and that way it will come down from the previous traded multiples of around 30, 35 plus to around 23. And if we take a realistic view, if we want to bump up the PE multiple by 10%, it may be around 25. In that case, if you look at in the conservative side, we would be making around 4.5% or barely 1% CAGR on this stock. And even on the realistic assumption side, we might be making around 11%. To top it off, we also have a dividend yield, which is actually in our favor. So Infosys declares dividend in the range of 2 to 2.5% every year. So you can add this yield to your calculation, which will actually give you the right estimate. But if you look at 11%, it is lower than the return that might be seeing on the Nifty 50. So my recommendation will not be to go forward with this stock, because what I see that there are multiple opportunities which are there in Nifty 50 which can provide you returns in excess of 15%. 11% is substandard. Over long term, we may say that Infosys is a large cap and it might touch the all-time high, but I still feel it's a long way to go, especially because IT services, IT companies, you can't look at those companies in the same fashion the way they have been seen post COVID. uh, Things will change, and they've already started changing. Don't fall in the trap that the 52-week high will be touched again. That is purely my recommendation, I would say so, mainly because based on the facts that I'm uh, uncovering now. Let me know how you feel about this talk. Happy to get the feedback on this, and we can discuss a lot. Please comment on what you feel is your recommendation on this talk. And also, if you like this content, please give a thumbs up. It gives him motivation to me to bring out such content to you and cover a lot more stocks, and also give alternatives to you. If not Infosys, then what all stock that you should be focusing on. Show your love, and I promise that I will deliver on whatever that is needed from my side. Thanks a lot everyone. Thank you for joining in. Bye.